Thank you for the lovely introductions. As Ray mentioned, I'm Dominic Procopio. Been with KPMG for 10 years now. I've been practicing tax rule 15. Work up in here in the Vaughan office in Ontario. Primarily focused on enterprise tax work, private owner managed businesses, and I'm specialized a lot in personal income taxes, which we're here today to discuss. So I'll start going through some of the slides here. I think I have the, just make sure I can click through it. There we go. All right, so there's a few range of topics that we're going to be going through here today, primarily again focused on personal income taxes and a lot of savings vehicles where you can put in money to reduce your ultimate personal income tax liability. But before we get into that, let's discuss now what personal income tax liability looks like and who is it applicable to. So typically here in Canada, just one second, just a little slow on the back end. So there's a bit of delay going through each slide here. Give me one second. Oh, there we are. All right, so in Canada, you're effectively taxed on personal income earned on worldwide income here in Canada and abroad if you're considered a resident for Canadian tax purposes. It's different than other countries where in the States you may be taxed based on residency or based on your nationality and your citizenship. Here in Canada, you're based on your residency. And we'll get into factors that can deem you to be a resident or whether or not you're considered a non-resident. Taxable income here in Canada includes all your worldwide income from employment, business, property, and capital gains. And the Canada Revenue Agency is the body that administers this. Each year, you assess your Canadian income tax liability on a calendar year basis. So you're looking from January 1st to December 31st. However, if you've immigrated into Canada partway through the year, your starting clock starts the date that you immigrate into Canada up till December the 31st. And any taxes owing for that taxation or that calendar year period is due on April the 30th of the following year. Now, there are different exemptions on when you need to file. Sometimes you can file by April 30th, some till June 15th, depending on what types of income you're reporting. But any payments owing based on that income is all going to be payable by April the 30th. So on those returns, you'd be reporting all of your income deductions, which we're going to get through in this presentation here. And when you work with your accountant to prepare these income tax returns, if you prepare it yourselves, there is metrics in there where you report all your worldwide income, not only earned in Canada, but abroad as well. So it's important that residency is kept at top of mind to determine whether or not you have that filing obligation. So now let's get into are you a resident in Canada? So there's two ways that this area will loop you into this test. The first being if you're factually resident in Canada, and that's if you have significant ties to Canada itself, which I'll get into shortly. And the second is if you're a deemed resident of Canada, spending more than 183 days here in Canada. Why it's 183 days? That's essentially more than half of the year. 365 days is the full year period. So if you're here for more than 183 days, you're deemed to have been here for more than half the year, and therefore they'll loop you into this deemed residency ruling. So the CRA considers you to be a newcomer for the first year that you come to Canada, and you become factual resident for Canadian income tax purposes if you have enough ties to Canada itself. Now, when we talk about ties, we look at two different factors. There's primary ties and secondary ties. The first primary tie is effectively the three major categories. If you own property, so a home here in Canada, whether or not your spouse lives with you here in Canada or common law partner, or if you have any dependents under the age of 18 here in Canada. Usually this is done on an assessment by assessment basis. And if you have any one of those three ties, you're typically deemed a resident here in Canada. There are secondary ties, though, that can loop you in, such as if whether or not you have a driver's license, a health card, whether or not you have social economic ties with, let's say, a gym membership, a bank account. Those factors help determine residency, and it's not a one size fit all. It is case by case basis. Some people may have a driver's license but no bank accounts. Some may not have a home here in Canada as it's being rented out. So it is individualized. You'll need to assess with your accountant to determine whether or not you would be classified as a resident. And there are actual forms that you can file with the CRA to determine whether or not you would be deemed a resident here in Canada. So again, if you're deemed resident in Canada, there's the 183-day period testing. However, there are treaty tiebreaker rules. So if you are here for an extended waiting certain period of time, depending on which country you've come from or which country you are a resident of in that jurisdiction, there are treaties between Canada and most other countries. And in there, you'll look to see whether or not you meet that testing to qualify as a resident here in Canada. Now, if you are considered a non-resident in Canada, so meaning that you're out of Canada for more than, or you're not in Canada for 183 days or more, if you're outside of Canada and abroad, and you're coming here on a temporary basis, there are certain tax rules that would loop you back in to be taxed here in Canada, which would typically be Canadian sourced income. But this again would be based on treaty tiebreaker rules to determine whether or not there's certain sources of income that would be taxed here in Canada. Now, for depending on, as I mentioned earlier, the starting dates, if you're coming into Canada and you're a part-year resident, there are certain things that are taxed on your return. It's worldwide income subsequent to the date that you become a resident here in Canada. And as well as part of the refundable credits and tax credits that are available to you, those are also prorated relative to the days that you are here in Canada. So on a calendar year basis, you may receive $18,000 worth of non-refundable credits if you are here for the full year period. That's prorated by the number of days that you are here in Canada and deemed a resident. That ties to your economic income because when you're reporting your income, you're only doing it for that period as well. So to avoid just claiming, let's say, a portion of the year's income and the full year credits, this year requires a proration calculation. And again, if you're a full year resident, you're taxed on both income inside and outside sources on a full year calendar year basis.
Okay, so now that you know about the residency and what would actually make you file a tax return in Canada, we're just going to go through some of the mechanics of how you would actually get a tax return filed and what you need in order to do so. So to start off, we have a taxpayer identification number, and we call that a SIN here in Canada, and that stands for a social insurance number. So you can register for this through Service Canada, either online or in person. And a SIN is used for more than just your tax return. It's also used for employment in Canada, to open most types of bank accounts, and to receive benefits and credits, which we will discuss later. If Service Canada isn't able to give you a SIN, then they'll give you a temporary number. But either way, you would have to go through Service Canada to get your identification number. So who has to file a tax return in Canada? So you want to file a tax return if you are paying tax in Canada or if you're going to claim a refund. And even if you have no income to report, you would still want to file a tax return, as some benefits and credits are based on your 2025 or that applicable year tax return filing. And those are automatic once you actually file your tax return. We'll go into the various credits later in the presentation, but in order to be eligible for these credits, you definitely want to file a tax return even if you have no income. Ways you can file your tax return include online or via paper. So online, there are two different ways. You can net file, which is through various programs that the CRA approves. This can be done by yourself. So you could either purchase the program online or a copy from various retailers. And then if you wanted to go through an authorized representative, they would use something called e-file, which allows the firm itself to e-file on your behalf. If you cannot file electronically, you can still file a paper return with the CRA, but they are recommending not to do this unless you have no other choice, as this usually delays the assessment of your return. So due dates for the tax return is generally April 30th. So this is for most individuals. Your tax return and the payment, if you have one outstanding, will both be due on April 30th. For 2025, that makes it April 30th, 2026. If you are self-employed, so you have income that you aren't earning through an employer and you're earning it directly via various sources, your return is due on June 15th. But make sure if there is a payment owing, that is made by April 30th, as that date stands for both individuals who are employed or self-employed. The only exception to these rules is if the April 30th or June 15th falls over a weekend, or in general, if there is a CRA recognized public holiday on a due date, the due date becomes the next following business day, and this applies for both the return itself and payments. Where you are not filing on time, there are penalties and interest that can be charged. So there are various penalties that can be charged for various filings. So for your personal tax return, if you are late filing this return, if there's a balance owing, there is a penalty charged of 5% of the balance owing, plus 1% for each full month that the return is late, up to a maximum of 12 months. There are also gross negligence and failure to report penalties. So this is only applied whether CRA thinks you have omitted something knowingly, or if you missed reporting income 2 or 3 years in a row. The penalty for failure to report income is the lesser of 10% of that unreported income or 50% of the understated tax. Any interest that may be accruing compounds daily, and this interest is not tax deductible. So if you do have an interest owing, try your best to make the payment by April 30th. Otherwise, interest will begin the next business day. So for 2026, that will be on May 1st. These interest rates are based on prescribed quarterly rates that are published by the CRA, and the current rate for the first quarter of 2026 is 7%. So now that you know what what you need in order to file the tax return and the various due dates, we're just going to go through how the tax is actually calculated. So for individuals in Canada, this is based on a progressive tax system, which means not all your income is taxed at the same rate. So instead, your income is divided into layers, and we call those layers tax brackets, and each layer is taxed at a different rate. So to offset some of this income, there's also non-refundable tax credits. And for 2025, halfway through the year, the federal government did change the rate from 15 to 14%. So for 2025, the average is 14.5. And just because this is a transitional period, there will be a one-time top-up tax credit, and that is calculated automatically by whatever program you may be using to file your tax return. To mirror the federal non-refundable tax credit, there's also an equivalent in Ontario, and the only difference will be the rates that they apply. So these are the various tax brackets that I mentioned earlier. So each bracket has a different rate, and then based on your income will be calculated using the various rates and the progressive marginal tax rate system. In Ontario, there are a few additional taxes. And so one of these taxes is called the surtax. This is calculated based on the actual Ontario tax that is calculated before the surtax is applied. So dependent on your income and what credits you may be receiving, you will be calculating an Ontario tax, and where your Ontario tax is more than 5,700, there would be a 20% surtax. And if you reach a point where it's over 7,300, then there's an additional 36%. So these taxes are applied on actual tax calculated and not on the taxable income. But if you were to look at an approximate income level for where these surtaxes would apply, the 20% starts at about 93,000, and the additional 36 is about 110. And another additional tax that's charged in Ontario is what we call the Ontario Health Premium. So this varies between $0 and $900 depending on your income level. And just for your reference, this usually starts to kick in around 20,000, and the $900 maximum is reached when your individual taxable income is over 200,000.
Perfect. So let's go through some common tax slips that are used to prepare your Canadian income tax return. Now, if this is your first year filing, or if you're unfamiliar with some of these forms, these are just the most consistent or the common ones that we've seen here when we're preparing returns, and your accountant will likely request this information. So T4 slip is effectively your slip from your employer that reports all of your annualized earnings. It reports any taxable benefits that you have with the corporation. It reports any RPP contributions, any withholdings for income tax purposes, CPP or EI that you've completed with your employer. All that will be reported on the T4 slip, and it reports effectively the income for the year. Your T5 slip is something that's issued usually by a banking institution or a financial institution. So when you do come to Canada and put money into a bank account or into an investment account, there are metrics in there where they track your interest income, capital gains, dividends. All that is tracked on T5 and T3 slips, and that's usually issued by the bank. For T4 slips, those are issued before February 28th. For T5, T3 slips, those are usually issued before March 31st. So keep in mind if you intend to file your return, let's say in early March, you may not have all of your slips available. So ensure that you connect with your banks. You look through the online portals to make sure you've downloaded all of your slips and they're available to you. Just that way you make sure you have everything available for your December 31st return. Two other common slips that we see are the T5007 slips, which are statement of benefits, and the T2202 slips, which is effectively your tuition slips for either yourselves or your children. There are metrics in there where you can claim credits on behalf of your children, up to about a $5,000 threshold for non-refundable taxes. And that's typically the most common slips that you'll see. You'll have to verify with your employer or your financial institutions if they're issuing any other slips, such as the T4PS, which is some profit sharing slips. So always confirm with your online portal to make sure you do have everything available to you when you visit your account come tax time. So now let's talk about property that you've owned prior to coming to Canada. So effectively in Canada, we have this capital gain regime where any accumulated growth on properties are taxed at capital gains rates. Now, this isn't effective on your principal residence. So if you do come to Canada, you buy a property, you live in it, and it appreciates in value, you're not being taxed on that income if you do meet the qualifications as a principal residence. Any other property, however, such as rental properties, investments in stocks, those fall into the capital gain regime and you will be paying tax on that. And the calculation is using what you've paid for that asset relative to the fair market value at the time of disposition. The difference between the two is treated as a capital gain and you're taxing your marginal rates based on that capital gain that's on your return. Now, for property you owned before coming to Canada, it may have appreciated in value, but fortunately, what the CRA says is when you come to Canada, the date that you come and deem yourself a resident here in Canada, you're deemed to automatically have sold and reacquired that property, which effectively refreshes how much that value is. So if you think about coming to Canada and let's say your property's appreciated $1 million, if let's say the fair market value at that time is around $1 million, you'd now be able to effectively have that value going forward, and any appreciation subsequent to that would be taxed as capital gains. That means that you're only paying tax on the appreciation of that property after the immigration date and not from the date that you acquired it. Now, T1135 reporting is effectively reporting any foreign assets that are outside of Canada or any foreign investments that are held in a Canadian brokerage account. So we were talking about property that you owned and the bumped up basis on those properties. Effectively, if you have any property outside of Canada, once you're now deemed a resident in Canada, you're required to report this on a form called T1135 if the value of that property or cost of that property is more than $100,000 Canadian. The CRA wants to know this just because if they want us to make sure that you're reporting all foreign income. So if you have, let's say, a property back home that has appreciated more than 100,000 and you're collecting rental income on it, they want to make sure that that asset's reported to them to inquire with you whether or not there is any sources of income that may be missed. Now, there are certain exemptions from this. So you'll note that on here we listed personal use items. That's not to be included. So if let's say you've left the home and it's vacant, or you're treating as a vacation property that you're going to be visiting every so often, that's not required to be reported on this form. Again, this form is intended to capture any foreign-based income that's not being reported. So if you have a foreign rental property, that's what they're trying to look for. And there are stiff penalties for missing this form. It is due April 30th in conjunction with your return. And for every day that you're late, it's a $25 penalty up to $2,500. So after that 100-day mark, you're paying $2,500 per year for every year you don't report these foreign assets. And if you have a history of repeat offense where you're not reporting this, you're going to be hit with this gross negligence penalty relative to the amount of years that are outstanding. So now assistance with filing a return, there are several clinics that the CRA offers, and they're usually available on their website. It changes every year, but they have specific requirements to meet in order to utilize some of these tax clinics. Now they're looking for taxpayers who have modest income between, let's say, 40,000 for a single person to about 55,000 for a family of two. And they're only looking for simple tax situations where you have employment income, pension income, RSPs, interest deductions. They're looking for very simple returns. They're not looking for anything, and we'll go to the next slide here, that has, for example, self-employment income, business income, rental income. If you have any of those sources of income that are listed on here, or if you even have that T1135 filing, which reports foreign-based assets, you wouldn't be able to use some of these clinics because the volunteers won't complete returns for these particular income thresholds, nor will they do it for deceased taxpayers' returns. So if you have a relative who's passed away during the year, they won't be able to prepare a deceased taxpayer's return just given the complexity there. If you do meet the qualifications, though, as mentioned in the other slide, where you have just those sources of income and minor deductions, then you may be eligible, depending on your income threshold, to utilize some of these clinics. And then from there, you'll just need to provide them with a valid source of ID, a SIN number, the tax slips that we mentioned earlier, and receipts. They are pretty great to work with, so you can connect with any one of them, and they should be able to provide you with a list of slips if you're not familiar with them.
Okay, so now that we know the basics of the Canadian personal tax system, we're going to get into some savings and investment vehicles that can be used as a Canadian resident. So an RRSP is a registered retirement savings plan, and this is one of Canada's main retirement saving tools. The biggest benefit is that the contributions are deductible, which would reduce your tax liability today. Investment income that is earned inside this RRSP is generally tax sheltered while it stays within the plan. And then once you withdraw from this plan, that's when you would actually be taxed. And so the idea here is when you're at retirement, your income is generally lower, so you would be benefiting from the marginal tax rates that we had discussed earlier. Just one thing to note for RSPs is to make a contribution towards your RSP, you need to have what we call contribution room. So you can find your available contribution room on your most recent notice of assessment if you have filed a tax return in the previous year. If you're new to Canada, then you would only start generating this room once you earn Canadian sourced income, such as employment income. And when you file your tax return, the calculation will be at the bottom of the notice of assessment. So the contribution room is also a calculation. So it is something that changes annually. It's either 18% of your earned income. And so earned income is sourced income from Canada sources. And the RSP contribution limit for 2025 is 32,490. Just be careful to monitor this contribution limit very carefully, as over contributions can be penalized. And so where you do over contribute, you may be faced with a 1% monthly penalty on the over contributed amount. For 2025, for those of you who can contribute, your last day to contribute will be 60 days after the calendar year, which takes us to March 2nd, 2026. Your RSP can also support you in major life programs. So there is a home buyers plan and there's also the lifelong learning plan. So these plans are referenced as the HBP and the LLP. So the HBP is applicable for first-time home buyers, where it allows you to withdraw up to 60,000 from your RSP, and this has to be repaid over 15 years. So generally, there's a little grace period, so the repayment can start the second year after your withdrawal. And say you don't make the minimal repayment that you are required, then that shortfall just gets added as taxable income in the year of the required payment. The LLP is a plan that helps fund full-time education. So this can be used by either you or your spouse for a lifetime maximum of 20,000 and a yearly maximum of 10,000. It is important to note, though, if you are trying to access the LLP, it cannot be used to fund your children's education. So another benefit to the RRSP is what we call the spousal RRSP. So the spousal RRSP is beneficial because it allows the spouse to include the income in their return when the retirement period eventually comes, but the contributor who is making these payments into the spousal RSP will be getting the deduction. So the idea here is splitting income for retirement. So if there is one spouse who is a higher earner with one making a little less, or then you are allowed to split this income by contributing into your spouse's RRSP, and which will be taxed in their hands on eventual withdrawal. Just one thing to remember though is the person contributing into the spousal RSP, it is their RSP contribution room that is used. So you just want to make sure you're monitoring that contribution room as mentioned previously, because any over contribution will result in a penalty. Another important note is if a payment is made into a spousal RSP, you want to make sure you're not withdrawing from this amount in the year that the contribution was made or in the following 2 years, as that income would be attributed back to the contributor of the plan. Another form of RSP that kind of falls in with the RSP is registered pension plans, and this is through your employer. So if you're employed in Canada, some employers offer this as a plan, so the corporation itself may match your contribution or do slightly less or more, depending on how many years of service you have with them. These contributions will show on your T4 slip, and there's a specific box which it shows in, which is box 20. And then for your RSP contribution room, this also plays a factor as this will lower the amount that you can withdraw through. Sorry, it will lower the amount you can contribute through any other financial institution. So if your employer is contributing into this plan, it is important to note that you will only get a deduction on your tax return for your personal portion. But if the income is withdrawn at any point in time, the entire withdrawal, whether it was made by you or your employer, will be taxed in your hands. These plans, the RPPs, are usually locked in until retirement, with limited exceptions, and that is pending your employer. Another commonly used savings vehicle is the TFSA, which is the tax-free savings account. This is one of the most flexible saving tools in Canada. So the contributions are made with after-tax dollars, which means you do not get a deduction for it on your tax return. However, any growth or withdrawal made from this account is also tax-free. So every year you receive new TFSA room, and the room only starts building when you become a Canadian tax resident. So there is no retroactive room for the years before you arrived in Canada. But every year that you are a resident in Canada, this room will continue to grow. For 2026, that room is 7,000. You can contribute up till your contribution limit in a year, but you cannot do more than that. And similar to the RSP, there can be penalties for over contributing. A newer savings vehicle, which was announced in April of 2023, is the FHSA, and this is the First Home Savings Account. This is a bit of a hybrid between the RRSP and the TFSA, in which the contributions that are made into this account are tax deductible, but the withdrawals are tax-free, similar to the TFSA. There are some criteria in which you need to meet to be able to qualify for the FHSA, and that would be if you're over 18 but under 71, you are a resident of Canada, and you did not own by yourself or with a spouse your own home in the previous 4 calendar years. If you are using the FHSA, in order to be able to withdraw from this account tax-free, you must be using it towards a purchase of a home in which you do qualify as a first-time home buyer. The residency piece is very important to the FHSA concept because you can only have this account and withdraw from it when you are a resident of Canada. The first-time home savings account has an annual limit of 8,000 to up to a lifetime maximum of 40, but it is important to note that this limit does not start until you actually open an account, which is different than your RSP and your TFSA. Those accounts don't need to be opened in order to accrue the limits, but with the FHSA, the limit only starts the day you open your account or the year you open your account. Another savings plan that is offered in Canada is the RESP, and this is a registered education savings plan. So these are government regulated accounts, and they're used for saving money for a child's post-secondary education. So the benefits of this is that the CRA is giving a tax break to Canadian residents to encourage them to save for your children's education. There's also various grants that the government provides if you do have one of these accounts open for your children. And depending on your personal contributions into these accounts, you're eligible for up to a maximum of 2,000 per child for one of the grants, and another grant you're eligible for up to 7,200 per child. The lifetime maximum of RESP is 50,000. So once you get to that limit, it's not beneficial in contributing over that. Because the RESP is contributed using after-tax dollars, there is no deduction for it on your tax return. But the savings here is when you, as a contributor, are putting money into this plan, when it is withdrawn by your child, this money would be taxed in their hands. And typically, we would expect children who are going through school to have little or minimal income. Any money that is earned in the RESP while it is in the account is not taxed until it is withdrawn, similar to the various other savings vehicles we discussed. Now, if you do open one of these accounts and say your child does not end up doing post-secondary education, there are various options you can do with this account. So you can leave it open in case your child does use it in various years thereafter, and it can be open for up to 36 years from the start date. You can also transfer it to another child if their individual contribution doesn't exceed 50,000. Or you can also transfer it to your own RSP pending your personal contribution limits. If none of those options work, you can close the RESP. Any grants that you may have received while this account was open would have to be repaid, but the other remaining money will just be taxed in your own hands.
Trying to keep up with some of the questions in the chat. If I've missed any, we can address some of them subsequent or at the end of the presentation. But let's go through some relevant tax credits and deductions available to most taxpayers. So there are quite a few, and they change every year. However, these are the primary ones that we see all the time, and affects pretty much everyone, depending on your family situation. So the first and foremost one we see is the child care expense deduction. Effectively, if you have any affordable care or if you have any Montessori childcare expenditures paid throughout the year, that can be claimed as a credit on your income tax return on an annual basis. So look at the calendar year, and you're eligible for any children under the age of 16. There are credits relative to the age. I believe after the age of 5, it gets ground down a little bit, but the child or the family can claim this child care expenditure. However, it's only going to be claimed on the lower income spouse. So if you have one spouse earning 100,000 and one spouse earning nothing, unfortunately, the CRA requires that that child care credit be claimed on the lower income spouse's return, which means you wouldn't get a credit for it because the individual spouse that's showing no income wouldn't be able to deduct anything to go into, let's say, the negative income. They just simply wouldn't get any deduction for it. So it's important to analyze your family dynamic to see the sources of income and where it's going to be claimed. There are exemptions to that, especially if, let's say, the lower income spouse is attending full-time school. The government doesn't want to penalize you for attending post-secondary education and not having an income, but still having childcare. So again, consult with your accountant to go through some of those exemptions if you find yourself in this predicament. Now, charitable donations. So donations are limited to 75% of your net income. Based on that calculation, you can donate that amount of money. You'll get a credit relative to what you've put in there. You need to make sure that the charity donation is in the year of the tax year that you're claiming it for. So, for example, if you're making a charitable contribution today, it wouldn't be applicable for the 2025 filing period that we're talking about. It would be applicable for next year when we file the taxes for, let's say, the 2026 taxation year. So, the date that you make that charitable contribution is important, and it's also important to ensure they're a registered charity with an RR number. You'll usually know that by a simple Google search, or they'll have it on their statements showing that they have that RR number. There are limitations, so you want to make sure that they're a Canadian charity. If they're non-registered charities or they're out of the country, let's say a US charity, there are other restrictions, and you have to have foreign income to effectively utilize those donations. So the best course or best case scenario is keep it within Canada and keep it up to 75% of income. So medical expenditures. This is a very heavily audited area with the CRA. You'll be surprised, even the smallest medical claim can be examined by them. They usually do this in the terms of sending out a letter to ask you to verify the medical expenditures that you're claiming. So who can you claim it for? You can claim it for your spouse and your common law partner and your children under the age of 18. Once they're over 18, they're required to include those medicals on their return, and you can no longer claim it for them, given that the government doesn't classify this as dependents anymore. So when you're looking at medical expenditures, again, it's for the year that's incurred. You're going to claim everything relative to what you've incurred for yourself, your spouse, your common law partner, your children. And that's going to be ranging from optometry, dentists, prescriptions, massage, chiropractor. The range goes on. And in fact, there's a CRA guideline province by province that tells you which medical expenditures are eligible for your province. So I encourage you to take a look at that guide and align it to what you've done in the past year to see whether or not you're eligible for certain medical expenditures. And again, they're looking at the 12-month period, but it's not necessarily a January to December requirement. With medicals, it's a little bit more flexible. If, let's say, you had a big medical expenditure in November of 24, and you had big medical expenditures in March of 2025, the CRA, and assuming you haven't claimed this, the CRA will allow you to change your 365-day period. Rather than you missing that November 2024 amount, you can claim that. However, you wouldn't be able to claim any November 2025 and December 2025 medical expenditures. So you have to shift that 365-day period relative to the maximum benefit. Your accountant can help you analyze this relative to your total listing of medical expenditures. Just know that the ending date has to occur in that tax year. So you'll always have to be the last day is December 31st. You'll never be able to dip into 2026 medical expenditures. That's for next year. So other relevant credits. So carrying charges and interest expenses. This is effectively if you're borrowing money for the purposes of investment. So if you get a home equity line of credit against your house, if you're borrowing money from a bank in terms of another line of credit or other sources of loans from third-party lenders, any interest paid on that you paid to effectively earn income from rental properties by putting a down payment or by putting the money into the market in stocks and bonds, you can effectively write out that interest relative to the amount you're putting into non-registered accounts. By non-registered accounts, what I mean is exactly what Mathangi was referring to earlier, the TFSAs, RSPs. If you're borrowing for the purposes of putting money into those accounts, the interest won't be deductible. It has to be for any accounts outside of that regime. Another common claim is the home buyer's amount. That's a non-refundable credit up to 10,000. That doesn't mean it's $10,000 back in your pocket. Non-refundable credits are usually calculated about 15%. So if you have taxes payable of, let's say, $5,000, this credit here will effectively get you $1,500 credit against it, and effectively you'd owe $3,750. The qualification for this is effectively if you hadn't owned a property here in Canada in the preceding 4-year period and you buy a home for the first time, this credit is available to you. And as I mentioned before, the tuition transfers, that T2202 form is effectively your child or your dependent going to university or any post-secondary schooling. Your credit can be transferred to your return to up to $5,000. Now, the benefits and credits, Mathangi mentioned earlier as well, it's important to get a SIN. You need a SIN in order to start filing returns and apply for benefits. You'll see on the next few slides that there are certain incentives that you can get from the government, such as the GST credit, HST credit, and the CCB. So the HST GST credit, you have to be over the age of 19, and there are certain income thresholds that you're required to meet in order to get this credit. These are paid on a quarterly basis and it's assessed every year automatically when you file your return. So it's nothing that you have to apply for separately. When your accountant files your return, you'll be effectively getting a document showing how much you're eligible for. I'll skip to the amounts here. So effectively, if you're entitled to it based on your income threshold, you could be up eligible up to, let's say, $533 per single individual, or up to, let's say, $700 for a married or common law relationship. These are adjusted annually every year. However, the income threshold for the current year is about 45,000. Only individuals under 45,000 would be eligible for this credit. The other major credit is effectively the CCB, which is the child care benefit. And that there is effectively any children that you have, you're automatically enrolled in this program and you're eligible for this childcare benefit up to a maximum of about $660 per month per child. So it's an annualized amount of $8,000. But again, this is prorated relative to your income. So your accountant, again, when you file your income tax returns, should be able to determine your eligible amount, and that's going to be based on family net income. So it's going to be your spouse and yourself's income. Amount there, if it's over the certain threshold, which gets indexed every year, you wouldn't be eligible for it. However, if you're under that threshold, you'd be receiving a pro rata amount every year. The period, I believe, for the CCB is from July the 1st to June 30th. So when you file your return in April, they'll calculate what you're going to receive starting in July.
Okay, so some other credits that may be some credits and various income that may be applicable to your situation is the Canadian Pension Plan. So this is referred to as the CPP. So you can start receiving CPP as early as 60, or you can defer this until 70 if you would like to receive a higher monthly amount. The CPP is available as long as you have worked in Canada and made at least one CPP contribution. The CPP that you may receive is reportable on your income, is reportable on your tax return for the following year. And this is reported through a T4A slip. This is issued directly by the CRA and Service Canada. So once you receive this, you would just input this in your tax return. Similar to the CPP, there is another income substitute for old age security. This is known as the OAS. So this can only begin at age 65 and cannot be started earlier. But if you would like to defer the OAS as well, you can defer until age 70 to receive higher monthly amounts. So the OAS is not based on work history. Instead, it is based on how long you've lived in Canada. Generally, to qualify for OAS, you would have needed to live here for at least 10 years after the age of 18. OAS is reported similarly to the CBP on a tax slip known as the T4A OAS. And when you receive this slip, you will be required to report it in your income. One thing to note about the OAS is if your income is above a certain level, all or part of your OAS may be clawed back. So in 2025, this OAS will begin to be reduced if your net income is over 93,000. Another benefit that is offered to Canadian residents are the Ontario Chilean benefit. This is broken down into various credits, which is the Northern Ontario Energy Credit, the Ontario Energy and Property Tax Credit, and the Ontario Sales Tax Credit. So in order to be eligible for any of these tax credits, you will need to file your tax return. And in your tax return, there is a form called ONBEN. So if you complete that form, the CRA will automatically assess your eligibility for the tax credit. So specifics about the Ontario Energy and Property Tax Credit. To qualify, you must have been an Ontario resident on December 31st, 2025. Similar to the GST, HST credit and the CCB, the benefit year runs from July to June. So for 2026, that benefit year will be July 2026 to June 2027. Some criteria you need to meet at some point before June 1st, 2027 includes being 18 or older, currently married or in a common law relationship, or a parent who lives or has lived with your child. So this benefit can be received if you paid property tax, if you paid any rent, if you lived on a reserve and paid home energy costs, or you lived in a public long-term care facility. The credit amounts that you could receive depends on your age and what type of payment you actually made. So for those who paid property tax or rent, you could receive up to a maximum of 1283 if you're under 65 and over 18. If you're 65 or older, this bumps up slightly to 1461. For those who are paid an amount to a long-term care home or lived on a reserve, the amount is $285. And if you lived in a private school resident or a designated college, university, campus residences, you receive $25. This credit is paid monthly and is tax-free, so you will not need to report it on your income tax return. Another component of the Ontario Trillium benefit is known as the Ontario Sales Tax Credit. So similar eligibility and similar benefit year, so from July to June. This benefit is only available if you're 19 years of older, so that is the one slight difference, and you can receive up to $371 for the year, and this is also paid monthly. If you do receive this credit, it does not hinder your eligibility for the GST HST credit, and this is also tax-free. So another benefit is the Canada Workers Benefit. And so this is a refundable tax credit. So even if you do not pay any other tax, you can receive this credit to you. It's intended to help individuals and families who are working and earning a lower income. So this has two parts. It's broken down between a basic amount and then a disability supplement. And again, similar to many of the other tax credits, this can be claimed when you file your personal tax return. The eligibility criteria is very similar. You need to be 19 years of older. You need to be a Canadian resident through Canada throughout the year, and you want to be earning income. And then the net income thresholds for this credit depends on the province. For Ontario, these amounts are 26,000, where you would where the credit itself starts to get grounded down. And then if you make over 38,000, it is eliminated entirely. The maximum you can get is 1633 for single individuals and 2800 for families. The income thresholds change slightly if you're looking at claiming this for a family. So the 27,000 becomes 30 and the 37,000 becomes almost 50. The disability supplement is allows for an additional 843, whether you're an individual or a family. The variance here is just the income threshold, so it will start to ground down around the $38,000 mark and is completely grounded down by 44,000. For families, it's slightly higher. It's about 50 and 60,000. And so we've also have a slide just on resources that can be used after our presentation itself. There are some good resources on CRA's website themselves. They have a portal solely for newcomers to Canada, and additional information can be found there. If you are interested in further webinars, they do have a webinar tomorrow for benefits and credits for adults 65 years and older. And then they have another benefit and credits for the younger population, and that is in a month on March 4th, 2026. And so at this time, we just wanted to thank you guys for listening in today. Uh, if you have any questions, we can open up the floor.
I did see one question that we had earlier in the Q&A box. I think it was, are student loans considered income?
Those shouldn't be. So student loans effectively is money that you receive, like let's say on OSAP purposes from the government. That wouldn't be considered income, but in fact, as well, the inverse is any interest paid on a student loan may be considered tax deductible.
Okay, we have one question here, which is, do the personal loan payments, can they be included while filing taxes as some sort of expense?
Personal loan payments.
Yes.
It depends on the nature of the loan. So, and it's not necessarily the loan payment. So let's say you're borrowing money for the purposes of investing. then the actual loan payment itself is broken up in between principal and interest. The principal is essentially you're just giving back money on what you borrowed. The interest component, though, would be deductible depending on what you use that money for. So again, if you used it for a down payment of a rental property, if you use it to invest in stocks, then the interest component of that payment may be deductible.
We have another question, which is I think this was might have been a question connected to another one, but it says, does that mean all loans for education are the same interest is tax deductible and not considered income?
You'd have to look at the loan itself. Most loans are not considered income because it's simply a grant to go to school. There would be slips issued by the government if they do give you a grant, and that would be taxable depending on your status at the school, if you're a full-time student or if you're a part-time student. So always abide by the tax slips depending on that grant. Most loans aren't, for example, like we are saying OSAP, but some maybe. And in fact, again, you can deduct most interest on these loans.
Awesome. And then I think this is actually probably the last question that we have because you answered all of them earlier. Is I am currently a resident of the UK for tax purposes, but will relocate to Canada next month. I did my soft landing in 2023. Do I need to file taxes for the year 2025 to access the childcare benefit and other benefits this year?
It depends again, even if your landed date was in 2023, you have to look at residency of when you would be considered a resident for tax purposes. And depending on how you filed in 2023, whether or not you did claim yourself to be a resident at that time, on those filings itself, it asks you what type of return it is. If you're a non-resident filing a non-resident return, or if you're a resident filing a regular return, you would have deemed yourself to the CRA as to your situation. So you may be considered a resident already, depending on your filing in 2023.
Gotcha. And then we actually had a few more come in, but maybe I'll do this one. Is salary received from employers outside of Canada qualified for simple tax filing for free tax clinic?
Depending on the source. So if
Okay.
it's employment income, very likely. If it's rental income or any other exemptions that are listed there, it wouldn't be eligible. You'd have to
Awesome.
confirm with the volunteer clinic, show them the sources of income you have, the letters, the documentation, and they'll tell you whether or not you'd be eligible.
Awesome. Well, in that case, I think that's a lot of questions that you've already had to answer. And then yeah, I'll pass it off to Maria if you have any closing comments.
Thank you, Tim. I just want to really thank both of our presenters, Dominic and Mathangi. This, as you can see, based on the volume of messages in the chat, like the expertise and the knowledge that you have and that you're willing to share with all of us is really needed and really appreciated. So thank you again for taking the time to prepare this and share it with our community. I want to thank also KPMG for the continued collaboration with us at Windmill. And thank you to all of you who attended and really participated and made this session a really interesting one. We hope that you're leaving with some confidence in what it means to file taxes in Ontario as a newcomer. And as Tim mentioned, please do complete the follow-up if you have any questions after you leave the session.